Hello and welcome. Today we're going to talk about inflation, something that affects everyone but can be hard to understand. We'll break it down step by step, so whether you're a student, an adult, or just curious, by the end of this video, you'll have a clear understanding of what inflation is, why it happens, and how it affects your everyday life. Let's start with the basics. Inflation is the rate at which the general level of prices for goods and services rises, and consequently, purchasing power falls. To put it simply, inflation means that over time, money loses its value. Example: imagine you bought a coffee for $2 5 years ago. Today, that same coffee might cost $2.30. That increase in price is inflation in action. Inflation doesn't happen overnight. It builds up gradually, which is why we don't always notice it right away. But over the long term, it can have a big impact on our savings and how we manage our finances. Real-life example. Think about how much prices have changed in the past decade. A loaf of bread, a gallon of milk, or even rent. The cost of many things goes up slowly over time. This is the effect of inflation, and it's a natural part of a growing economy. So, how do we know if inflation is happening? The most common way to measure inflation is through something called the Consumer Price Index, CPI. The CPI tracks the prices of a basket of everyday items like food, clothing, and transportation. If the cost of that basket increases over time, inflation is happening. But there's more to the story. The CPI doesn't capture every price change. For example, it may not track the cost of all luxury items or services like streaming subscriptions. Still, it gives us a good picture of inflation that we can use to plan our finances. Example: if the price of gasoline goes up by 10%, while the price of your morning coffee increases by only 2%, CPI might show a more general picture of how your spending is affected. Even though individual prices vary, we can see an overall increase. Inflation doesn't just happen for no reason. There are a few main factors that cause it. Demand pull inflation. This happens when demand for goods and services exceeds supply. Example: let's say there's a popular new gaming console, and suddenly everyone wants one. If there are only a limited number of consoles available, the price will go up because people are willing to pay more to get their hands on one. Cost push inflation. This occurs when the cost of producing goods and services goes up. Example: imagine the price of oil goes up because of a supply shortage. It costs more to transport goods, and businesses might raise the price of products to cover their increased costs. Think of the price of airfares rising when fuel prices increase. Built-in inflation. Sometimes inflation happens because businesses and workers expect it. Example: if workers expect prices to rise, they may demand higher wages to keep up. In turn, businesses raise prices to cover these higher wages. This cycle of rising wages and rising prices is called a wage price spiral. Now that we've covered inflation, let's briefly discuss its opposite, deflation. Deflation occurs when the general level of prices for goods and services falls, and as a result, purchasing power increases. Essentially, in a deflationary environment, money becomes more valuable over time. Example: imagine you have $100 today, and in a deflationary economy, you could buy more goods and services with that same $100 next year than you could today. The prices of goods like food, electronics, and cars would go down, making it easier to afford things with the same amount of money. But deflation can also be harmful, especially if it lasts too long. How does deflation affect the economy? While deflation might sound good at first, who doesn't like lower prices? It can cause serious problems if it's not controlled. When prices fall, consumers and businesses may start delaying their purchases because they expect prices to keep decreasing. This can lead to a slowdown in economic activity. Example: if you know that a TV will be 10% cheaper in a few months, you might hold off on buying it. If everyone thinks this way, businesses struggle to sell their products, and the economy can slow down significantly. The deflationary spiral. A major concern with deflation is the possibility of a deflationary spiral. This happens when falling prices lead to reduced consumer demand, which forces businesses to cut wages and jobs, leading to even less spending, and so on. This can be damaging for the economy and lead to a period of economic stagnation or even recession. Now that we know what inflation is and why it happens, let's talk about how it affects us. Purchasing power. When inflation happens, the value of money decreases, so you can buy less with the same amount of money. Example: a few years ago, $10 might have been enough to buy a meal at a nice restaurant. Today, the same meal might cost $12. If your income hasn't increased in line with inflation, you might find yourself cutting back on things like dining out or entertainment. Savings and investments. Inflation can also hurt your savings. Let's say you have $1,000 in a savings account earning 1% interest. If inflation is 3%, that means you're losing money in real terms. Example: imagine you put $1,000 in a savings account today. A year from now, after earning $10 in interest, your total savings would be $1,010. But because inflation has been 3%, the purchasing power of your $1,010 is actually less than the $1,000 you had last year. Debt. On the other hand, inflation can help people who have debt. Example: let's say you owe $100,000 on your mortgage. If inflation causes your salary to rise over time, you'll have more money to pay down that debt. But the $100,000 you owe is still in nominal terms. Its value has decreased due to inflation. This is why inflation can sometimes be seen as beneficial for borrowers. Not everyone is affected by inflation in the same way. Consumers, people who are on fixed incomes like retirees, are particularly hurt by inflation because their purchasing power decreases. Example: a retiree with a pension may have a fixed income. If inflation rises, the same amount of pension income buys fewer goods and services than before. Workers, employees who don't get raises that match inflation can struggle. But workers who are able to negotiate higher wages during inflation may be better off. Example: if inflation is 5% and you're able to get a 6% raise, you're actually better off as your purchasing power has increased. But if you only get a 2% raise, you're losing out. Business owners may raise prices to match inflation, but they also have to deal with higher costs of raw materials and labor. Small businesses may suffer the most because they often can't increase their prices as quickly or easily as larger companies. Governments and central banks, like the Federal Reserve in the US, try to keep inflation at a healthy level. Too little inflation can lead to stagnation, while too much inflation can cause economic instability. Monetary and fiscal policy. Central banks and governments must often balance measures to fight both inflation and deflation. In times of inflation, the central bank may raise interest rates to reduce the money supply and curb price increases. In times of deflation, the central bank might lower interest rates to encourage borrowing, spending, and investment. Example: if a country is experiencing a deflationary crisis, the central bank may drastically cut interest rates to make borrowing easier, and the government may introduce stimulus packages to encourage spending. To wrap up, inflation and deflation are natural parts of the economy, but they affect us in different ways. Inflation can erode purchasing power, but a moderate level of inflation is important for economic growth. Deflation, while it can increase the value of money, can also lead to economic stagnation if left unchecked. It's important to understand both of these concepts so that you can make informed financial decisions. Thank you for watching. If you found this video helpful, please give it a like, subscribe to the channel, and leave a comment with any questions you may have. Stay tuned for more financial tips and explanations in future videos.